Until April 2025. Here is what happened if you miss a $50 installment payment on a pair of sneakers bought through a buy online, buy now, pay later app. Nothing, no marks on your credit file, no signal to your next lender, no contribution to the statistics regulators use to measure how much debt American households actually carry. That invisibility wasn't an oversight. It was, by every account, a deliberate product feature, and it's eroding right now. The basic mechanism is simple. Split purchase into four interest-free installments, typically paid every 2 weeks, with the merchant, not the shopper, covering the costs through a discount on each transaction. What started as a curiosity around 2019 scaled explosively. 335.8 million individual loans originated in the United States by 2023 alone, according to the Consumer Financial Protection Bureau's own data. By 2025, the global BNPL market reached approximately $560 billion in transaction volume, serving over 380 million users worldwide, representing 5 to 6% of all global e-commerce payments. Klarna alone had 42.8 million American users as of 2024, averaging $513 in spending each, available at checkout on over 375,000 US websites. Here is the finding that deserves the most scrutiny because it reveals a genuine measurement problem. A firm a firm's own reported 30-plus day delinquency rate stood at 2.8% as of March 2026, a figure that sounds entirely manageable. Consumer survey data tells a starkly different story. A 2026 LendingTree survey found that 47% of all BNPL users reported being late on a payment, up from 24% in a 2024 Federal Reserve survey. A single-digit delinquency rate and a near 50% self-reported late payment rate are describing two very different realities, and the gap between them is precisely the blind spot regulators are now racing to close. It is worth being direct about why this reporting gap existed for so long. It was commercially useful. A borrower juggling several simultaneous BNPL loans across different apps had no way of knowing those obligations could ever appear on a future credit application. And lenders benefited from offering what felt like frictionless consequence, free credit. At December 2024 Federal Reserve Board research note explicitly flagged that this inconsistency in reporting makes it difficult for both consumers to understand their own real exposure and for other lenders to make fully informed decisions when extending additional credit to the same borrower. A firm began reporting BPNL BNPL loans to credit bureaus in 2025, a genuine structural shift. Klarna and Afterpay have moved more cautiously, but FICO has begun building BNPL data into its scoring models, creating mounting pressure on every provider to follow. The Richmond Federal Reserve explicitly flagged the previous invisibility as a systemic risk earlier in 2026. The Richmond Fed's own calculation drawing on CFBP data put average outstanding BNPL debt at $3.02 billion at any given time, a figure that had simply never been factored into standard measures of household debt exposure. The practical consequence for anyone currently using BNPL, a missed payment habit that once carried no visible consequence, can now directly affect a future mortgage, auto loan, or credit card application. The usage pattern has also shifted in ways that raise the regulatory stakes. What began as a discretionary retail tool, clothing, electronics, sneakers, has expanded into groceries, healthcare, education, and travel categories, where payment discipline carries considerably higher real-world consequences than a missed payment on a discretionary purchase. This broadening use case is precisely what's driving new regulatory scrutiny. A missed BNPL payment on pair of shoes is an inconvenience. A missed BNPL payment on a medical bill or grocery installment plan is a genuinely different category of financial risk, and it's the category BNPL usage is increasingly moving into. If you currently use BNPL services, the practical takeaway is straightforward and increasingly urgent. Assume every one of those loans is now visible or will shortly become visible to future lenders and treat missed payments with the same seriousness you would a credit card. The era of BNPL functioning as a consequence free credit light is ending, provider by provider, and borrowers who continue treating it that way are likely to be genuinely surprised the next time they apply for a mortgage or an auto loan. $560 billion in transaction volume grew largely in a genuine measurement blind spot, invisible to the statistics regulators use, invisible to the credit files lenders rely on, invisible even to many of the borrowers themselves, who had no simple way to see their own total exposure across multiple simultaneous apps. That blind spot is closing now, provider by provider, and the debt was never actually invisible, only the record of it. Thank you so much for your presence, and I'm really looking forward your reflections, your questions, feedback, personal experiences. It's very important. If you've ever had any BPNL personal experience, please share it. Let us know how it went, if it went well, if you ever faced a problem because of due diligences on your BNPL payments. Have you already realized by experience the impact this could have on your financial stability? Let us know in the comments. Thank you so much once again for your presence.